Hello, this is Brian Overby. I am the author of the Options Playbook and your host for Options Guide TV for about the next 20 minutes. Today's going to be short and sweet. I am obviously still traveling, so you get to look at my little picture down in the lower left-hand corner. Today, I'm just going to ride the momentum of the SPX. So what do we have going on in the market? The big buzzword this week is dot plot. The Fed is going to come out and this week and talk a little bit about their forecasts as to how many rate cuts they actually see going throughout 2024. The first high probability of a rate cut right now, according to the futures, is going to be in June. But the dot plot has been getting a lot of ink lately in all the financial news, and it looks basically it's a forecast of all of the people that contribute to the Fed. And right now it's saying that there's a potential for 3 cuts in 2024. So that's not officially out, but that's what rumor has it. And the markets are reacting very strong today. A little bit to that news, but just a lot that's going on in the economic data, which is really good for March. A lot of times when we've had a big run up in the marketplace, all through the first part of the year, going all the way into February. Once you get into March, we'll get a little bit of a sell-off. Is kind of just the general seasonality of the marketplace, but we're obviously not having that. The market has stayed strong all through March. We're already here on March 18th, and we see that the S&P 500 index today is up 1%, trading at 5170. So I'm going to ride that wave. I'm traveling this week. This is a position that I have on in my account, and the one trade that I'm doing this week is just selling or buying and at the money. In my mind, it's an at the money long call spread. Now I can adjust this, so I'm just going to run to this and I'm going to show you that, and this is going to be our trade for the week. I'll talk a little bit about what we did in Amazon on Friday to our larger paper trading portfolio, but this week our paper trade is going to be in the SPX. And if we do have to adjust the trade, we will make that adjustment on Wednesday. Obviously, it's not always ideal when we tape Options Guide TV to make the adjustment during the show, but I'll follow it closely tomorrow and we'll see where we're at on Wednesday if this does happen. So the market actually has gone down a little bit since I first started doing my research, and I like it when it's more at the money for this particular strategy that I have talked about in the past, but it is totally a momentum short-term trade. So I'm going to remove these. We're going to go out to the 22nd, which is 4 days away. It's the SPXW. This is the Friday. Then obviously the following Monday would be 7 days away, March 25th. So we're going to make sure we're using that expiration. 0322 it says over here. Market's at 170 right now, highlighted by the Trade Hawk software option grids. We got the call on this side, we got the put on this side, and the most at the money option contract is highlighted here in yellow. So in order to set up this trade, we're going to go 10 points wide. We're going to buy a long call spread. We're going to be neutral to bullish, more bullish than neutral. But when we set this trade up, we're actually going to be buying less time premium than we're selling. And this is going to be for a long call spread. So it's also known as a debit spread. And I usually, when you think about debit spreads, you don't think of the fact that you're okay with time decay. Normally, when you do a debit spread and you pay that, you usually pay more time premium than you sell. But if you set it up this way, where I am buying less time premium than I sell, that means that the market can actually go down a little bit and we would be okay on this trade. The break even, another way to say that is that the break even can be below where the current marketplace is at. But real strong market today, up $52, up at almost exactly 1% at this second. And the trade, I always like to go about 10 points wide. If you're in the S&P 500 index in the ETF, if you're in the SPY, I usually will go wider than this only because in the SPY, that's only a 1 point spread. But in the SPX, you can do 10 points wide. I will sometimes do 15 points wide also. But on the adjustment, it makes it a little bit harder to adjust. Okay. So with that said, let's go 10 points wide. It's going to be a fairly inexpensive 10-point wide long call spread. So here we have the bid is 42.20 and the ask is 42.40. We're going to click on that ask price. That's going to add the 51.60 strike call option. That is obviously in the money. So we have some intrinsic value and some extrinsic value, or otherwise known as time value. I say extrinsic value because in the chains we have a column. I have it set up with a column for the extrinsic value. I then am going to click on the 5170, which is the most at the money. The market's really moving right now, but the most at the money option contract. And I like to sell this option mainly because there's so much time premium in it. That's where all the time premium settles, not only in the S&P 500 index, but in all underlyings. The bulk of the time premium usually is on the most at the money option contract. And as you go further and further out, it's obvious the time value is going to go down because you're farther out of the money. That's less excitement to own that option contract. But when you go deeper and deeper in the money, that's also the case. You get more intrinsic value, and the option contract becomes more and more intrinsically worth more and more. And the time premium actually starts, I should say, becomes smaller and smaller. So it becomes more intrinsic or more intrinsic and less extrinsic. All right. So, and I'm going to highlight that right here. By keeping this column in here, we see that this option contract of 5160 with the market at 5168, so 8 points and change in the money, is trading for an extrinsic value of $34.78. The most at the money option contract, which is just a little bit out of the money, a point and a half or so, is now trading for $37 worth of intrinsic value. So the difference here is fairly substantial. And because of that, we can get this trade done for a very solid price, if you will, of $5. We'll use what we have here. The midpoint is 570. Let's put it at 570. That's probably where I would try to enter this trade by the way that it's bouncing around. So you're paying 570 for a 10-point wide SPX option contract. If the market just stays above 5170, this spread will be worth $10. So to find the maximum that you can make on this trade, you take the width of the spread, which is $10, minus the net debit paid, which is $5.70, and any fees that you may have. And the maximum you can make is $4.30 on this trade. But that happens if the market stays right where it's at, or if the market continues on up. It can even come down a little bit. So the break-even point is the strike that you bought, which is 5160, plus the net debit paid, which is 570. So 5165.70 is the break even. 5165.70, so just above the 5165 strike. So the market could even come down a little bit and this trade would be profitable. Now we're doing this on a Monday. I like, if I'm doing the long call spreads, I'd like to do them on a Monday with an expiration on a Friday. If anything, I might even choose a shorter term expiration. You could do the Thursday. I just don't like being in this trade over the weekend because I do want to make an adjustment if the market goes against me. And so in this scenario, we're doing this trade. If the market is flat or opens up tomorrow, it's good for this trade. You want as much time premium to erode on this at the money on option contract as possible. That's your biggest headwind in this situation. Obviously, if the market does go down, well, that's going to hurt you a lot. If it does, what we'll end up doing is actually rolling this into a butterfly, which will give us the possibility of the market coming back and landing within the wings of our butterfly. But to start with here, we're just going to be buying a long call spread, and we are paying, in my mind, a very fair price because we're selling so much time premium on that at the money option contract. And I guess I did want to kind of mention one thing that is interesting, and I think it has a lot to do with the Fed meeting, is that the VIX is being very sticky right around that 1434 level. Even though we have a really strong update today, the VIX hasn't moved at all. As a matter of fact, it's just down 7 cents. And I think that has a lot to do with the fact that the Fed is going to be chatting it up this week. So because of this, we it just shows that there's a little bit of nervousness in the marketplace, right? So we have a very strong bullish move, and the VIX is saying we don't really believe it. Now, that's just one factor. Ideally, on a big up day like this, you'd like to see the VIX come off a couple of percent on the downside. So if you got the SPX going up 1%, you'd expect the VIX to go down maybe 2 or 3% if you want to look at it on a percentage basis, apples to apples comparison. So that's the only thing that's kind of highlighting here is that the VIX is just staying sticky right around that 14% level. We are going to buy the 5160 strike call, sell the 5170. A break even is 5165.70 because we're paying $5.70 for this trade. If the market goes down, what we'll do is we'll sell one more of the 5170s and buy one of the 5180s. And that would make us a standard butterfly trade. So we have some time today. So let me take a second here, and I apologize, you're gonna have to see my screen, but let's show this in the options playbook, which it is a new and revamped options playbook. We just launched a new site this week, so definitely go and check it out. But this is my book online. All the content from the book is actually available for free online at optionsplaybook.com. There's the URL. So here's the long call spread. And if I'm going to go in and pull up a couple of more strategies, so let's opening a few tabs here. And the other strategy that we're going to look at is if we go to the seasoned veteran trades, we're going to talk about a short call spread. And then if we combine both of those trades, guess what we end up with is, I think it's in seasoned veterans, we end up with a long butterfly with calls. So let's go right here, skip strike, long butterfly with calls. There we go. Okay. All right. So let's start by looking at the long butterfly with calls. So here's a long butterfly with calls, usually done for a lot smaller net debit than the same width flat out long call spread. But if you can work with me here, you can see that this really is a long call. If you buy strike A and just sell strike B, I'm going to move my mouse fairly slow here, is you're going to see that it's going to go all the way up, and I'll show you this in just a second on the actual long call, and then it's going to continue on out this way. So that would be a profit and loss graph at expiration for a long call. And you see that right here. Here's the profit and loss graph, goes up to strike B, and then it continues on up with limited and known upside. Now, if you look at the short call spread, here's what you have. Well, let's go back to the butterfly first. Let me apologize for jumping around, but here we go. So on this, if you sold strike B, which you're doing inside the strategy, you're going to sell 2 of strike B. If we sold strike B and you have it this way and you sell strike B, you would go from strike C to strike B, and then you would continue on out this way. And if we show you that, here's the profit and loss graph here. So the way that I propose the strategy and the way that I like to approach it is we're going to buy the long call spread. And if the market goes if it goes up, everything's simple, right? If the market continues on up this way as expiration approaches and we go higher and higher and higher and higher, this trade's going to work out just fine. But what I'm saying is, what if the market goes down? So the market should be somewhere right about where the break even is at. And if the market goes this way, well, then we got an issue because we're losing money on the long call spread. We can sell it and get out. Or if you still want to play in the game, what we can do then is sell the short call spread. And then what happens is this line and this line get canceled out from that action, and you end up with a butterfly. Now, it's an expensive butterfly because you didn't put it all on at once and the market went the wrong direction. So it's not really helping you as far as the total cost of the butterfly. But it allows you to stay in the market and it allows you to take some risk off the table. So you start with this trade, market goes this direction, then you do this trade, and then you end up in this trade. And normally, if I'm going to make that adjustment, it's going to happen on Tuesday or it's going to happen on Wednesday. As you get closer and closer to expiration, when you go to sell the short call spread, there's no meat on the bone. There's just not as much time premium available as you get closer and closer to that expiration date. So it's fairly important that we do it, that if the market does move, that it moves against us early because we can bring in more of a net credit on the short call spread. Ideally, we're correct on our forecasts. So we don't have to worry about that too much, but that's the whole strategy. And it's a strategy that if you are bullish on the market, this is one way that I like to approach it. And I'm just going to make it very simple this week because I'm traveling. We're going to look at this trade. We're also going to come back and maybe consider selling a call on our Amazon position. The market's up a little bit today, so you're going to have to watch this one more time. I'm going to tab around and get back to the TradeHawk software. But Amazon right now is up about what the market is. Well, Apple's strong today. That's good to see, up 2%. But Amazon's up almost 1%. We got the SPX around 1% up. So if we get a little bit more of a stronger move, I may sell a call on our Amazon position. And if you want to know what I'm talking about, please go back and look at the archives for Options Guide TV for Friday. We have a paper trading portfolio. This is an actual TradeHawk account. But in our paper trading portfolio, we are managing a bunch of deep in the money option contracts. Some of those contracts and some of those strategies, we're doing what's called the fig leaf. You can find that inside the options playbook. And to complete the fig leaf, we need to sell a call against the brand new Amazon position that we put in. So we'll probably look at that on Monday. We'll come back and hopefully the market goes with us in the S&P 500 index. It stays strong going in to the close today. But if not, on Wednesday, we'll make that adjustment. We'll sell 151.70 and buy 151.80, giving us a 10-point wide spread, or ideally from 160 to 180, that would give us a 20-point wide landing area where the market might help us out if we go all the way to Friday and we are down on that position. It will allow us to have an out on this trade without adding additional margin or additional risk to the trade. That's the whole concept and the moral to the story. Short and sweet this week. I'll see you this Wednesday for the next edition of Options Guide TV. If you are on the Tradier platform, please click subscribe. I should say YouTube platform. Please click subscribe and ring the bell so you get all the alerts on the YouTube platform. If not, that means you're probably in the Tradier Hub. And we'll see you this Wednesday once again in the Tradier Hub for Options Guide TV. Hope to see you there.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.